Welcome back to OK Computer. I am joined here by a friend of mine, Adam Nelson. He is a partner over at FirstMark Capital. I think many of our listeners know Rick Heitzman, who is the CEO, co-founder of FirstMark. I've gotten to know Adam over the last year and a half or so. We've had lots of great conversations about FinTech. You are focused on FinTech over at FirstMark. So Adam, welcome to OK Computer.
Oh, thanks for having me. Excited to be here.
All right, let's talk about this because your background's really interesting. You were an operator. You worked at some very prominent sort of firms in Silicon Valley, and you made your way to New York as a VC here. You were also an investor out there a little bit. Love to walk through a little bit of your background here and how you got to FirstMark here in New York City.
Yeah, absolutely. I mean, I think it's funny. I just saw a tweet today about how liberal arts had
tweet.
A tweet.
Are you still on the Twitter? What is that
I still use the Twitter.
Yeah.
I abandoned my Mastodon a little bit ago, but no. So there was a tweet about how liberal arts kind of concentrations are going down nationwide, and that's a good thing. I was like the quintessential liberal arts student, and actually I think that trend has followed throughout my career. So I tried 3 or 4 different majors in college, everything from neuroscience to architecture, and then ended up in poli-sci with doing a lot of econ. Mm-hmm. Came out of school in 2006 and had no idea what I wanted to do with my life. And that, for a bunch of people who had no idea what they wanted to do with their lives at that time, they ended up on Wall Street. So I got a good 4-year investment banking, private equity training ground, focusing on consumer products. So everything from meat and chicken production and Pepsi and Coke and beverage, and so nothing at all with tech. But I was really lucky because I got the opportunity to go out to Stanford for business school, go out to the West Coast, and very cliche, within a month of being in Silicon Valley was hey, this is I've been going to chemicals plants in New Jersey, and I could actually be thinking about these companies like Facebook and Twitter that were really changing the world in pretty compelling ways. So I got excited. I kind of took the opportunity to be a student there, to take nights, weekends, every minute I had to become an intern and offer free services to folks like Twitter, startups like Cove, which eventually got bought by Dropbox, which is how I ended up there, Stripe in the very early days. So got some pretty incredible experience through that. And then ended up joining Dropbox full time, when they were just launching their business product, and helped to build out a couple different business units over there, all focused on kind of partnerships and basically how you create levered distribution. And that's a big theme I get excited about, kind of B2B to C, B2B to B, just anything that kind of gives you a cheat code in how you get software in the hands of users and businesses. And I love the experience, kind of wild growth at Dropbox, 10x on every metric over 3 years that I was there. Was a very exciting talent pool, very grateful for that experience. And then moved over to the investing side, got recruited by the folks at Social Capital, Chamath, Mamoon, Ted, really incredible team, and learned how to do early stage investing. And it's kind of a cool combination of, my history on, kind of traditional finance and also kind of the experience of entrepreneurship and being an operator. And I think that kind of combo just felt right and was the right fit, and then had the opportunity to come back home to New York and join the folks at FirstMark, and it's been an incredible path ever since.
So talk to me, if you're a liberal arts major, you just graduated in 2023 here, right? And generally, again, what do people do? They go to consulting, they go to banking, they do this, that. What is the path towards VC? I get this question a lot. I'm obviously not, I've been a public markets investor. When I got out of college in the mid-90s, people wanted to go to Wall Street. And so there was banking, there was sales and trading, investing, on the buy side, that sort of thing. VC wasn't really a thing. Private markets weren't a thing. And it's really interesting because Rick and I are very similar in age. I think he graduated from college a year before me. But the fact that he was doing privates at a multi-strat fund in 2000 is really be like, I didn't know anybody doing that. You know what I mean? I knew people that worked at the fund that he worked at Pequot, but they were all trading public markets. So what is the typical path right now for VC? I know what it is for PE. These guys and gals, they get out of a finance major, they go do investment banking for a couple of years. They literally start interviewing right away for that job 2 years out or thinking about business school. But VC seems a bit different.
Yeah, and it's interesting. It's you also then have to adjust for the last 10 years in VC may not have been representative of certainly what the norm is and what the next 10 years might look like. I think the easiest answer is to say there's no hard and fast rule. I feel like when I was coming out of business school, the trope was business school students are useless. Don't back them for entrepreneurs. Don't have them become VCs. In my class, I have folks like David Velez from Nubank who started a tens of billions of dollar company, and a ton of friends who are really successful VCs. So I think the common knowledge is always a little suspect. At the same time, a bunch of folks who have failed on that pathway. And so I think, stepping back, there are a lot of different, if you think about a VC and what you're asked to do every day, especially being an investing partner, there's going to be some mix biz dev, right? Some people do incredible job doing kind of over-the-top marketing. Some people are on Twitter all day. Some people are at events all the time. So it's like sales. It's like you're kind of a brand and you're kind of thinking about the right way to kind of get your message out into the market. There's obviously the kind of thematic investing side of it, understanding where the world is going in a very macro way, because you're making bets that ultimately need to pay off on a 5 to 10 year time horizon, but the best ones are probably non-obvious at the time that you're making them. You have to pick the individual companies. You have to know those companies, get close to them. You have to then win a competitive situation. And then you have to generally, for kind of hands-on investors like us, be hand in hand with those companies and help them from the earliest stages to IPO and beyond as a kind of a sounding board and help kind of be a force multiplier for those entrepreneurs. So there is this kind of massive set of things that are kind of all lumped together in one core that I think is both what makes it really exciting. It makes it a little amorphous. I know a lot of folks who come into the industry and just like don't even know where to start. And I think the ramp period is really long. And I think anybody who tells you differently is either lying or had an experience where it wasn't long because they lived through this kind of crazy bubble over the last couple of years. And so I think it's coming back to your question, because it's such a kind of composition of different skill sets and different temperaments, I think there are a lot of different ways to be successful. And I think you can look at the Midas list and find people who are on Twitter every day and find people who don't have a Twitter account. You can find people who have been doing venture for their entire life. You can find people who started in venture full-time when they were in their 40s. And any of those actually work. And if you look at truthfully, the history of venture, that will have been the case. I think it all comes down to being able to find the right themes, find the right networks, and then kind of execute on that core particularly well.
So let's talk a little bit about you came back to New York. You were a FinTech focused investor here. It seems that, as you've had this exodus of Silicon Valley, throughout the last few years, and it really did spread out, obviously Austin, Miami, it feels like New York, and I've said this on many occasions, and I'm not being biased because this is my home, but I see it all around me. It really seems to be a massive beneficiary in a way that Miami will not likely be. And the stuff, there was a lot of crypto bros and doing that sort of thing. But just because the proximity to Wall Street, it seems like this is the place for FinTech. Talk to me a little bit about your focus. You said you started out going to chicken plants and doing a lot of consumer focused things. But finance has become a very inherently consumer focused thing. And I could, you and I could go through lots of examples how some of the big financial institutions, they've kind of kind of miss certain tech trends. They go in, they make really bad acquisitions. We could talk about Goldman Sachs has made a huge push in consumer finance, and none of it seems to be really working. And then you see these other companies that just start from scratch. You just used the example of Nubank, one of your business school, partner. I mean, like literally, a massive company started from scratch in a geography that a lot of folks weren't too focused on, I guess. So talk to me a little bit about your focus there and kind of what your outlook is, and also being here in New York. Do you agree with me that this is really an important place to be as a fintech investor, especially in the private markets?
Yeah, absolutely. I mean, I think maybe I'll kind of answer both questions with the same theme, which is I think the most exciting thing that's happened over the last decade is that we've been able to produce things that were very hard to build, that were very kind of labor intensive to build, that had kind of their own, core defensibility. And we've been able to do a really good job of actually kind of delivering those as some abstraction layer, right? Like, I think if you kind of look at the theme of the last 10 years in Silicon Valley, it's been true, whether that's cloud computing, whether that's just like the know-how to build a startup and what YC has done, as well as just democratizing, I'd say, a lot of the core tenets of startup building. And then I think finance is now like we're at that kind of next tier in fintech. And so I think that's the thing to get really excited about. And in some ways, even at the time I joined FirstMark, I wouldn't have defined myself as necessarily a fintech investor. I was really interested in this idea that all of the big kind of legacy industries that I had spent time investing in were, being kind of could be revolutionized in some way by software, right? Like a lot of the stuff that was kind of very, kind of old hat to me, sitting in front of my, Apple PC at Dropbox and going into Slack and using Google Sheets and, kind of building on AWS was things that were, that future was not actually evenly distributed. And it was actually kind of really hadn't impacted big legacy industries.
Did Web3 fix that?
Well, no, I don't think.
Sorry. Go ahead.
But that's for the next bubble
podcast.
cycle. Exactly. And so I think that was kind of the theme I got excited about, and I thought SaaS effectively kind of being delivered into that that sort was going to be the big wave that I was following on. So I would have defined myself as vertical software, and in some ways, fintech would have been a vertical that we focused on. I think the really exciting thing over the last couple of years, and in some ways it was enabled by the massive glut of venture capital that went into fintech startups, is that the ability to build a bank, to embed payments, to embed lending, to do underwriting. All of this stuff went from, a kind of core IP that was built within these companies, even within a new bank, and could be delivered as effectively a microservice that could be managed through software. Now, it's not as easy as going and kind of spinning up an AWS server, but if you think about what it used to be, which was a bank charter and, 5 years of getting a business and everything, we're certainly further along that spectrum. And I think we're really excited about a lot of the infrastructure companies today that are building that future. Yeah. And so that is kind of, as I step back, I thought that, kind of a little bit of the prepared mind of being in vertical software and, talking to a bunch of companies there, many of which were having trouble kind of monetizing, having trouble trying to get large industries like construction or logistics, et cetera, to onboard to their software. Much of that was happening because you couldn't kind of embed a transaction layer there. Like you couldn't kind of go and do the buying and selling of goods in the software because you couldn't do payments, you couldn't put liquidity in. And I think that like that is the big thing we get excited about right now is like instead of building a new bank or new bank from scratch, it's like what are the kind of core banking primitives that can be kind of delivered in the workflow tools that you're using every day.
Yeah.
When the kind of standard is pen and paper and fax machines and PDFs, which it still is in a lot of these industries, there's just a massive opportunity to bring them online.
Yeah, we had a great conversation last week on the pod with Stuart Sopp, the CEO and co-founder of Current, our fine sponsor, or one of our fine sponsors of the podcast, and his co-founder, Trevor Marshall, who's the CTO. And really, we talked a lot about this and kind of how they built from the ground up. And it was actually a great conversation. But you had a blog on the FirstMark website last month. It was May 31. We'll put it in the show notes. Negative CAC and the next generation of fintech. And I thought this was really interesting. Negative CAC is the go-to-market and product strategy that enables companies to acquire a net new customer at no marginal cost. An extension of the paid functionality of their software delivers to existing customers. Talk to me a little bit about that. How did you? It seems like something that you've been developing this thesis. It kind of like I see the through line with what you just kind of discussed here a little bit. But I thought it was a really great note, and it seems like this is kind of a path where you're taking all of those skill sets that you have kind of been working on, over the last 15 years or so, and now this is basically a new thesis how you're kind of thinking about SaaS and fintech and the like.
Yeah, it feels like you kind of it's all happening. Yeah, it's all happening for me, and I think for the industry, all at the right time. I think basically the core thesis there, and it builds off kind of what I was just describing, where a lot of the kind of financial services infrastructure is now able to be built into software that folks will use on a daily basis, and I think as a result, what we're seeing is the ability to take that workflow tool. So think about it as like property management software, right? If you think about property management software, this is just like, sounds a little boring, right? But this is, every building in New York is being managed using some software product. They're trying to figure out how you collect rent. They're trying to figure out how you manage maintenance requests, how you do move-ins. And that is, in some ways, kind of a sleepy little hole of the vertical SaaS industry. But then you think about how much payment volume and how much economic activity is going through that one software platform, right? So you have all of the tenants and all of their spend. That's not, and rent is like the number one spend item for a tenant. You have the landlords themselves who are getting paid out from these property management companies, and you have the property managers who are effectively paying contractors and spending to go fix toilets and spending on new pipes and that sort of thing. And so if you think about it, this one software product actually gives you access to 3 different kind of core customers for financial services that are pretty well understood. So if I said, a consumer-facing credit card, you know what that's worth to you, right? If a consumer kind of uses it as their primary spend card. And Built Rewards is a company that's done a really nice job kind of hitting that niche. If I talk to you about that property management company, you would say, well, you're doing, receivables factoring, payments factoring, spend management, so you can give them an actual card that gets interchange. Those are well understood revenue streams that financial services companies get. And then if you think about the landlord, insurance, mortgages, again, being able to get paid instantly rather than waiting 30, 60, 90 days. And then underlying, if you can manage that whole kind of revenue stream, the float associated with it. So it's like a very kind of narrow example, but I just described 6 different financial services companies that would normally be built to service all of these different customers. And I think the thing that gets us really excited is because of all of these, kind of fintech infrastructure layers and kind of banking primitives, like that could probably be accessed in a 1-2 year time frame. So all of a sudden, there's $1 trillion of economic activity that can all go through this platform that can be leveraged in really interesting ways.
And that's the acquisition of a net new customer at no marginal cost, right?
Yeah, that's it's that, and not only that, but you're getting paid.
Yes.
Because everybody pays for property management software, so the property manager is paying you, but you have all of these kind of other revenue streams that in some cases are being monetized based on completely different customers because of where they sit in the value chain. And that's the thing we get really excited about is like all of a sudden you're kind of taking what seems like a relatively capped TAM part of a market and you're multiplying it by maybe 10x because of all of the different adjacent financial streams that they have access to.
So when you just gave, I think what you think is a niche-y example, but it's a really good example. What are some industries that you think are kind of saturated with this sort of, kind of behavior or the way they're being served? And what do you think are some that are going to be really big, like really interesting TAMs as you think about like the different companies that might agree exactly with what your vision is and they're building for that?
Yeah, I mean, I think we're still in the earliest days. I mean, I think like Toast has done a really nice job, right, in restaurants. I think Square. I think like some of these payments was kind of the sharp tip of the spear here, right? Like it was very clear how you could monetize those, and folks went through the largest kind of consumer payment endpoints. So I think those may be a little tougher to get into. And I think in some ways why I'd be really excited about companies like Toast and Square in the public markets, because I think they have so much room to run based on where they sit in the funds flow for restaurants, Main Street, et cetera. But I think like the real kind of core of the economy, the B2B wholesale part of the economy, construction supply, trucking, that I think is still in the earliest days because up until, even a year ago, most of the companies that that are offering some of these infrastructure layers really weren't ready for prime time. And I think we're still at a level where there's a lot of vaporware relative to what is possible. But I think if we look 5-10 years out, our belief is that you're going to see a bunch of companies that have these compound business models. There's some SaaS piece, there's some payments piece, there's some other financial services piece that are going to be going public and will effectively be creating kind of net new value in the core verticals that they're going after, as well as taking share from the traditional financial services infrastructure. Because if you think about it, for banks, their best bet on how to acquire a customer is, let's go sponsor Art Basel and let's go, put our sign, on a bench outside the street and put a bunch of branches. Like that's, the difference between that and saying like, hey, you're about to get paid in 30 days. Do you want that money now for a 1% fee? And we understand how to underwrite that because we know so much about the customer, the goods being delivered, and you as a seller. It's just night and day.
Well, you just mentioned payments as like kind of the tip of the spear, and that this is a great example. I mean, I think this kind of put FinTech on the map, if you will, at least in like the kind of public retail investor mindset a little bit. At one point, a couple years ago, PayPal's market cap was greater than that of Bank of America. And right now, even being down 80% or so from its all-time highs in 2021, it still has a $73 billion market cap. It has 47% gross margins. They're going to do close to $30 billion in sales this year. It is a very profitable company. It trades at 13 times earnings and 2.5 times sales, and they're expected to grow, let's say, earnings, double digits for the next few years or so. So the public market, at least investors in the public markets, they're basically saying this trade is over, right?
Yeah.
So the pull forward and the adoption and all that sort of stuff. And it's interesting to me because I look at that and I say, that's as cheap as chips. And we're looking at a NASDAQ that's up 30%. We're seeing this frenzy in and around AI. I have to assume that a lot of what you just talked about, the way you're describing, the way a lot of these businesses are kind of being built, there's a lot of machine learning built into a lot of this, especially when it comes to lending and payments and kind of, so talk talk to me a little bit about what you're seeing in the private markets and what's going on in the public markets, because it's really a tale of two cities now. And again, going back to my conversation with Trevor and Stuart last week, they're starting to see green shoots in the private markets here, and they're seeing some excitement. And maybe it's in and around the edges of kind of a lot of the AI frenzy that's going on, because a lot of these companies were kind of built on those ethos, if you will, right? You had to embed these sorts of technologies to do better than the incumbents, right? These large, like stodgy banks that, yes, invest billions of dollars in tech, but they're not doing it particularly well.
Yeah. I mean, I think a couple things have happened. I think, first of all, the thing that will stay with us no matter what is, there was this sense that, every tech company should trade at this revenue multiple that was, in 2021, everyone traded at these kind of high revenue multiples, and all revenue was treated equal. And obviously, from our background, like ultimately it's coming down to cash flows and earnings, right? And actually even more so these days, cash flows adjusted for stock-based compensation, which is a huge impact there. So I think that I think hopefully, or our expectation is that world is gone, and you're going to have to look at things relative to the right comparable set of what they're dealing with. So I think in some ways, there's a little bit of reality that's coming into financial services, which are, if you're doing, net interest margin business, like you're going to trade more like a traditional lender than you should trade like Salesforce. Like it's just, you have much more in common with them. You have the same kind of structural risk. You have the same, kind of cyclical dynamics. And so I think that that is something that is here to stay, and we have to just internalize as an industry, right? So not to say PayPal in particular, because they're kind of a combination of different businesses, but I think that ultimately you're going to be looking at some of the parts for all these businesses, and that's going to be a really important piece of how we underwrite anything. And even at Series A, we're thinking about what does this ultimately trade at, and what are the real life comps. And yes, it's going to have some tech pixie dust. Yes, it should be growing more aggressively, but you can't, you can't have that in your underwriting to assume that that's going to work. In terms of the private markets and how much they've internalized this, I think it's moving slowly down, the further. So, the public investors obviously get it. And then there's the, crossover guys. And then it kind of goes, late stage and then early stage. And I think it's kind of seeping its way into Series A. Seed is still kind of a party. People has not gone down materially. Our friends at ENIAC actually just wrote a post on that I thought was interesting. And so I think that, we're still in the early days of just digesting a new economic reality and having that work through the little economy that is, startups, many of which sell to each other, many of which depend on, were effectively levered to the growth of spend and headcount at other startups, or the acquisition of customers through other startups. And by the way, a startup could still be a Series E company, but I think anybody who's in this pre-public world where this hasn't flowed through, I think there's still a little bit of kind of reckoning that's gonna come. And I think
on a valuation basis,
it's just it's how these and it's not even a valuation basis. It's like, all right, well, maybe your investors have mark to market. Maybe you've kind of even internally understood that, but you're still thinking, well, I have enough cash flow to get to this point. But increasingly, more and more companies will have to make decisions as that kind of cash runway comes back in. And so I think we're going to see a lot of consolidation.
All right, so I wanted to go there because here's a great example. So you brought up Toast before. This is a company that's trading, down considerably from its late 2021 IPO. It IPO'd at $40. It's trading 22.5. It's got a $12 billion market cap. They have $1 billion in cash and no real debt, but they're still losing money. They're growing sales, let's say 20% a year. It's got 23% gross margins. This is not something that's that exciting, although it's servicing. It checks a lot of the boxes of things that you're interested in being disruptive and that sort of thing. But how does a company like this if there's still going to be a reckoning in the private markets, you know what I mean, for some valuations of companies that did raises at big valuations back in late 21 or something like that.
Yeah.
I don't know how a company like this works in the public markets to a $20 billion market cap back to where it was. It's still down 65% from its all-time highs. It's just like the one thing that the NASDAQ up, let's say 30% this year is masking, like we didn't really have a prolonged period, I think, of like, you know, a reckoning, if you will.
Or there was a mini reckoning.
It was a mini reckoning, and it did start in 2021. You know, the NASDAQ still closed up on the year, you know what I mean, in 2021, but crypto started selling off, SPAC started selling off, you know, recent IPOs started selling off. So the high valuation, losing money started selling off. And then, you know, the S&P topped out the first week of of 2022, and then we had a bear market. But just the flip of the calendar this year, and it's parties back on here.
Yeah. Well, also, I think it's like, where's that coming from? I mean, you're watching the public markets more actively than I am, but you know, I think it's coming from NVIDIA, it's coming from Microsoft, it's coming from the biggest platform companies that I think you know, rightfully you look at and you say they should this kind of LLM explosion should disproportionately benefit them, at least in the near term. You know, and I think that it's probably right? I'm not sure that that's working its way down to Toast, et cetera. I mean, maybe from a you know, kind of macro index perspective. I do think that if we look back in 2021, the thing that maybe we got right, and I believe we got right, there weren't a lot of things, but as a market, I think we looked at a lot of these tech companies, and I think we said the TAMs are just much bigger than we anticipated. The staying power of these companies to just compound over time is much bigger than anticipated, and their defensibility is increasing over time because of some of the network dynamics that they work through. And I think that that's how I would look at something like a Toast. I think that's how I would look at something like a Square, which is to say that they are still just scratching the surface of the industries that they can be going after, right? You know, single percentage points. And I think not only in terms of their you know, kind of install base, but in terms of what they can do from that position. And so I think that that would be my long-term view, which is, you know, at some point you need to, and maybe we're midway through the adjustment. I don't spend enough time in the public markets to really know where we are. There's been an adjustment. These guys went down 80%. Maybe they popped back 20%. But, you know, we kind of are back at near historic 10-year multiples, right? And I think that's the playing field we live on. But I think the exciting thing over the long arc is that, you know, this is the direction things are moving, right? We still live in a world where, you know, people are working on, you know, servers in their in office. You know, it's I think it's I think we're still in the early innings of a lot of the trends that we get excited about, and I think seeing a lot of trends now start kind of combining with each other. You know, so if you think about embedded fintech, you know, vertical software, cloud software, you know, microservices to make software development much faster and cheaper. Now AI, which will impact both, you know, what it takes to build a software company, what it takes to distribute a software company, and kind of and you know, the broad impact on the economy. I think that's like seeing these things compound on each other is also going to just exacerbate that trend. So I think that's why we do what we do. I mean, it's still, you know, you can look and say, all right, well, you know, the market has to digest these new, you know, kind of valuations. All right, you know, we're going to have a couple years where things are going to be tough and probably will get tougher for this little sub-economy, even if the broader economy doesn't have a hard landing. But over the long arc, you got to be so excited about where we sit and the opportunities ahead.
Yeah, and I think to your point, I mean, right now in the first 6 months of 2023, I mean, most of the gains have been accrued to these large platform companies, like you said, who have been positioned for this sort of excitement around the first product. I think that like people can see commercialized in and around AI, but it's going to be a lot of these other examples that you just gave that are a bit more niche or a bit more verticalized that are going to have a very long runway once we get comfortable with the IPOs. Well, listen, Adam Nelson, I really appreciate you coming over and having this conversation with us. I hope we can do it again. I'm sure we will in the not so distant future. Thanks a lot for joining us.
Yeah, thanks for having me.